Okay, let's unpack this. Welcome to a deep dive from TalkTickers. We cut through the noise of earnings calls to bring you the really important insights.
Exactly. Our job is to give you that essential knowledge fast.
And today, we're diving into the Q1 2025 results from a company right in the thick of this AI compute race. And, well, spoiler alert, things look pretty exciting.
Oh, absolutely. What's fascinating here isn't just, another quarter. It's the context. You're seeing a company in genuine hypergrowth, just fueled by this, seemingly endless demand for AI infrastructure.
Right.
We'll hit the numbers, sure, but also the strategy, their competitive position, where they might be heading.
Okay, so let's jump straight in. Headline numbers for Q1 2025. The revenue growth year over year is just, frankly, eye-popping. We're talking nearly 400%.
Yeah, it's huge. And the analyzed run rate revenue, even more striking, I think, almost 700% year over year growth there. That really shows the momentum in that core infrastructure business.
They're firing on all cylinders, it seems.
Definitely. They also finished the quarter with a solid cash balance, $1.44 billion.
Okay, solid numbers, but here's where it gets really interesting, right? Let's dig into the financials a bit more and, crucially, where they see things going, the guidance.
Absolutely. So for the full year 2025, they're sticking to their guns on the analyzed run rate, the ARR guidance. That's $750 million to $1 billion. Still a wide range, mind you.
Right.
And the overall group revenue guidance, that remains $500 million to $700 million. But what's really interesting is the momentum they talked about carrying into Q2. April's ARR apparently already hit $310 million.
Wow.
And they explicitly said demand is staying strong into May. So Q1 wasn't just a blip, it seems.
And amidst all this spending and growth, what about the path to actually, making money, profitability?
Yeah, good question. They kept their adjusted EBITDA guidance. So that's earnings before interest, taxes, depreciation, amortization, the core operational picture. They expect that to be negative for the full year.
Okay, still investing heavily.
Right. But they plan to turn positive on that adjusted EBITDA metric sometime in the second half of 2025. And actually, the core infrastructure business, just that piece, they think will hit positive adjusted EBITDA even sooner, probably Q3.
So the core engine gets profitable first.
Exactly. And then the next goal after that, which is a tougher metric, is positive adjusted EBIT. So that includes the depreciation hit from all the hardware.
Speaking of hardware costs, they mentioned capital expenditures, CapEx. Looks like they've actually upped the guidance there.
That's right. Key point. CapEx is now planned at roughly $2 billion for 2025. That's up quite a bit from the $1.5 billion they guided before.
Why the increase?
Well, a couple of things. They said some planned spending from late Q4 slipped into early Q1, so a bit of timing. But more importantly, they want to be, and this is their word, opportunistic.
Opportunistic, meaning?
Meaning they want to ramp up infrastructure capacity aggressively now to chase and lock down the demand they're seeing. They even mentioned looking beyond their initial data center plans, like that new facility in Israel. They see it as a great market opportunity. It signals real confidence, I think, in deploying capital quickly.
Okay, that makes sense. And looking further out, midterm, they painted a pretty ambitious picture there too, didn't they?
They did. Midterm for them means effectively a few years out. And in that time frame, they believe the business can hit mid-single digit billions of dollars in revenue.
Billions, wow.
Yeah. And to get there, they're building out their capacity pipeline with the ambition to potentially exceed 1 gigawatt of power, which is a massive amount of power.
Enough for potentially more revenue than even that guidance.
Potentially, yes. Significantly more. But achieving that kind of, accelerated growth depends on getting more buy-in from big enterprise customers, signing larger, longer-term deals, things like that.
And what about profitability in that midterm view? Still investing or making good margins?
They expect medium-term EBIT margins, so profit after everything, including depreciation, in the 20% to 30% range. They really believe the business can grow profitably at scale.
What supports that belief?
A few things. The scale itself, obviously. Their full stack offering, especially the software layer, which should carry higher margins. And interestingly, they use a conservative 4-year depreciation schedule for their hardware.
Shorter than usual.
Yeah, typical is more like 5 or 6 years. So booking those costs faster might mean the underlying cash generation is stronger earlier than the EBIT number shows. And longer term, they see margins potentially going well north of 30% if they keep scaling successfully.
Okay, ambitious targets. But funding all this, that $2 billion in CapEx this year alone, with $1.44 billion cash at quarter end, How do they plan to finance all this rapid expansion?
Yeah, this is honestly maybe one of the most interesting parts of their story. They spent $544 million on CapEx in Q1 using cash on hand. But going forward, they argue they're in a very favorable and pretty unique position to finance growth efficiently.
How so? Not just debt and equity like everyone else.
Well, that's the key. Their primary lever, they say, is monetizing equity stakes they hold in various non-core businesses. They gave examples. Their roughly 28% stake in Clickhouse, which, might have been valued around $6 billion recently.
Okay, significant.
Right. Then there's a big majority economic interest in Toloca, which just got investments from Jeff Bezos and others. And they have AV Ride, an autonomous vehicle team, where they're talking to investors but plan to keep a significant stake.
So the idea is to sell parts of these other businesses to fund the core AI cloud growth, without diluting the main company's stock or taking on lots of debt?
Exactly that. They really emphasize this as a very attractive financing source, minimize shareholder dilution, stay disciplined on debt. They know they can tap traditional markets, being public, but these non-core assets are presented as the main tool.
And they don't have much debt now.
Almost none, they said, which gives them a lot of flexibility to just plow revenue back into the core AI business. It's definitely, it's an unconventional approach for this kind of scale up. Oh, and just a note, that Toloca deconsolidation closed in May, so that will affect the financials from Q2 onwards.
Got it. Okay, beyond the numbers and this unique financing, what's actually drawing customers to their platform? What's the strategy to keep this momentum going?
Fundamentally, it's just exceptionally strong demand for AI compute. That was true in Q1, and they say it's continuing strong in Q2. They feel customers really get the value.
What specific value? Why choose them?
They highlighted reliability, scalability, and maybe most importantly, speed. Getting access to big GPU clusters in days, not weeks or months. That's a huge deal.
Oh, your pain point, yeah.
Definitely. They've also ramped up their sales and support teams, pre-sales, solution architects, customer success, now doing 247 global support. Apparently that smoothed things out a lot. Brand awareness is growing too, things like that. Semi-analysis gold status help. And their strategy of getting the newest chips, like NVIDIA's latest, online early, plus offering flexible contracts, pay-as-you-go, reservations that seems to be working. They mentioned the DeepSeek moment in February, needing H200s quickly as an example.
Right.
And they hit a record number of managed customers in Q1. Plus, looking ahead, getting those new Blackwell clusters online in the second half should provide another revenue boost and more confidence in hitting that guidance.
You mentioned capacity build out earlier. Tell us more about where they're actually putting all this new gear. Is it just US focused?
No, it's becoming more global. They're aggressively building and buying data center space. So updates include New Jersey, that's a build to suit, operational late summer, capacity rolling out based on demand. Kansas City is partly live with Hopper GPUs. The second part gets Blackwells in Q2.
Okay.
Iceland is fully operational. Finland's first phase is late Q3, second phase near year end. Operationally, they expect to have over 100 megawatts deployed this year. And that site in Israel is interesting. Opens a new market with a strong AI scene, startups, enterprises, R&D.
A foothold there.
Yeah, and they see it as maybe a first step towards supporting what they called national AI factories elsewhere, Europe, Middle East. So thinking big geographically, not just scale.
And the tech itself, they talked about their stack being a differentiator. What makes it special?
Yeah, they see their full stack approach built specifically for AI as a key edge over maybe other newer clouds. It's got layers, hardware management, then a virtualized cloud platform flexibility, like the hyperscalers use, and then an application layer with pre-configured AI tools.
So trying to make it easier for developers.
Exactly. They shipped something like 50 products or updates in Q1 across their AI Cloud and AI Studio. Key things included upgrades using Slurm, that's cluster management software, improving reliability and recovery. Apparently boosted usable nodes by around 5%, which is pretty significant uptime improvement.
Definitely matters for big training runs.
For sure. They also moved key tools like MLflow and JupyterLab notebooks to general availability. Big focus on reliability and performance, to mention speeding up object storage access, which helps get data to the GPUs faster for training, partnering with storage leaders like DDN and Weka for the next-gen Blackwell clusters, and integrating with external platforms like Metaflow, SkyPilot, to reduce friction for users.
Sounds like the partner ecosystem is pretty critical overall, especially that NVIDIA relationship.
Oh, absolutely critical. They highlighted progress expanding the whole ecosystem storage, ISVs, channel partners. But yeah, the NVIDIA relationship is clearly core, longstanding. NVIDIA is an investor.
Right.
And in Q1, lots of announcements there. There'll be one of the first clouds with NVIDIA's Blackwell Ultra AI factory platform, the GB300 and VL72 instances, launch partner for NVIDIA Dynamo for inference scaling, named one of only 5 global reference platform partners for NVIDIA Cloud.
That's a big validation.
Huge validation of their tech. And they'll support the DGX Cloud Lepton marketplace at launch. They use the phrase in lockstep with NVIDIA. Clearly see that as fundamental.
So pulling it together on customers, who are they actually selling to now? And where are the big future opportunities they're targeting?
Okay, right now, the base is hundreds of users, mostly AI native startups, smart, fast-growing, venture-backed, often US-based, which fits where they built capacity first.
Makes sense.
But where next? They see massive potential in sectors they haven't fully tapped. One is pharma, and these frontier AI labs, they need huge data centers, which they're now building towards. 2, and maybe the biggest near-term opportunity, is the enterprise market.
Big corporations.
Exactly. More global, needs the full stack, higher level services. They believe they're one of the few non-hyperscalers who can actually serve those global corporate clients effectively. 3rd, potential market. Those national AI projects we mentioned, building dedicated AI factories for countries.
Interesting. And why do these customers choose them beyond just GPU access?
Performance, resilience, scalability, sure, but also deep expertise, a hands-on approach, and helping customers get a better return on their AI spend. They gave examples like Captions, an AI video company getting to market faster, and Quanner, a biopharma accelerating drug discovery. They're really trying to verticalize solutions now, retail, robotics, etc.
And the contracts, are people locking in for long periods?
It's flexible, they emphasize, ranges from months to a year or more right now. But they did say the arrival of new chips like Blackwell is sparking conversations about longer-term commitments. They're experimenting, pay as you go, different reservation types, trying to meet different needs.
Let's circle back to that software stack. You said it's a differentiator. How does it compare, and how does it actually impact the financials?
Right, so they built it from the ground up for AI workloads. That's the key differentiator they push. Those layers, hardware management, virtualized platform, application tools, all aim to streamline the AI process. Q1 saw lots of product updates focused on reliability, like those Slurm upgrades, and performance, like the faster object storage.
But the financial impact, is it generating much revenue on its own?
Directly, probably not a huge percentage today. But they argue it's absolutely essential value add. It's what lets customers spin up huge clusters quickly, manage data, track experiments. It drives adoption and makes the platform sticky.
So it helps sell the expensive hardware access.
Exactly. They believe the software lets them reach more customers, offer potentially higher margin services layered on top, keep people on the platform, and ultimately get more effective revenue per GPU than just renting bare metal. Over time, yes, they see it becoming a more significant standalone driver of higher margins. It's a big part of their medium-term profit story.
Okay. One last detail, any mention of external risks. Things like global tariffs potentially affecting hardware costs.
They touched on it briefly, acknowledged the uncertainty around tariffs, but based on what they know now, they don't think it will cause major changes to their expansion or significantly hit costs. But, they added the usual caveat. It's a dynamic situation. They're watching it closely.
Right, standard procedure. Okay, so boiling all this down, what are the key takeaways for you, the listener, trying to get your head around this company in this space?
Well, I think this deep dive shows a company just experiencing truly explosive growth, and they're backing it up with really aggressive expansion plans and spending. They're clearly riding that massive wave of demand for specialized AI compute.
And their strategy.
It seems multifaceted, strong technical differentiation with that full stack, key strategic partnerships, especially NVIDIA, and targeting a broadening customer base, AI natives now, but eyes firmly set on enterprises and even national projects.
And the path forward.
They're investing heavily now, obviously, hence the negative adjusted EBITDA expected for the year. But they've laid out a path to operational profitability pretty soon, with ambitious margin goals longer term, banking on scale and that software value. And maybe the most unique angle is that financing strategy using non-core assets. They present it as a major advantage for funding growth without heavy dilution or debt.
So overall,
It's a picture of incredibly rapid scale up in a super critical high demand market. They're betting big on their tech, their partners, and this rather unique financing model to carve out a major long-term position.
Okay, all right, buckle up everyone. This next bit is purely informational, maybe entertaining, but absolutely positively not financial advice. Just us thinking out loud.
Yeah, treat this like a thought experiment. Imagine pitching a wild idea to some hypothetical, very risk-tolerant investment committee. Okay, given their focus on that software stack and the non-core asset financing, how about this? A pairs trade.
Yeah.
Go long this company, betting hard on their software differentiation and unique funding driving superior scaling and margins. And at the same time, go short a competitor who's maybe more focused on just providing bare metal GPU access and has to rely only on traditional debt and equity markets.
So betting their specific model wins out decisively.
Exactly. The outrageous part is the conviction required, assuming their differentiators basically guarantee they outperform in this cash-hungry race.
Okay, I like it. Or how about this one? Even simpler, maybe crazier. A highly leveraged long position, but betting almost entirely on them cracking those future growth markets, the big enterprises and the national AI projects, way faster than anyone expects.
I'm going to ignore the current burn rate.
Pretty much ignore the near-term burn, yeah. Focus solely on the idea that those non-core assets provide enough fuel to bridge them to capturing those massive, still largely untapped markets ahead of schedule. Betting purely on those future catalysts, slingshotting them to those mid-single-digit billions.
High risk, high potential reward scenario. But again, just brainstorming here. Seriously, do your own research. Don't trade based on this.
Absolutely. Okay, so wrapping up this deep dive into their Q1 2025 results, what did we really learn? We saw that explosive revenue growth, confirming huge demand. Bold expansion plans backed by more spending.
Yep. A clear strategy built on their tech stack and partnerships, especially NVIDIA, and that really fascinating, potentially unique way they plan to fund it all using those other business stakes.
We covered their roadmap to profitability, why that software stack matters, even if it's not big revenue yet, and who they're targeting, from startups today to enterprises and maybe even countries tomorrow.
It's clear they're playing in a high-stakes, super high-growth game, right at the heart of building out the infrastructure for whatever AI brings next.
Which leaves us and you with a big question to think about, doesn't it?
I think so. In this global race to build the AI futures foundation, will the ultimate winners be defined just by who builds the most hardware, the biggest scale? Or will it be those who can innovate across the full software stack and find clever, maybe unconventional ways to finance that massive scale?
Something to chew on. Thanks for joining us for this TalkTickers deep dive. Remember, this is all based on the source materials provided to us, and it is definitely not financial advice. We look forward to diving deep with you again soon.